Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the biggest catalysts facing investors as U.S. stocks trade within points of record highs. Plus, we break down where the big, beautiful bill stands in Congress as the Senate plans revisions for the bill. And we'll break down the state of the consumer as Smucker's comes under pressure amid a top and bottom line miss. All that and more coming up right here on Catalysts. Half an hour into the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages. Is this what summer vacation is going to look like on Wall Street? Because we got another muted morning here. Your S&P up just about 0.2%. Your tech-heavy NASDAQ up 0.2%. Per usual, any rally that we are seeing being driven primarily by the big tech names. Having said that, I do want to take a look over at the bond market here because it's been interesting. We've got some big treasury auctions this week. You can see yields down just a tick. You've got your 10-year down about 4 basis points, your 30-year down 4 basis points as well. But as I was saying, we've got some bond auctions over the course of this week, and it's going to be really interesting to see what the demand picture looks like at those auctions here. And we've already seen a little bit of a slowdown in demand. So the big question is whether or not that is indicative of investors fleeing the United States or if it's just a little bit of other diversification going on. We're going to cover that throughout the show. But finally, let's take a look over at Bitcoin. It is moving to the upside, nearing 110,000. It is up nearly 2% this morning. Well, tech stocks leading the market rally once again as the possibility of easing trade tensions lifts investor sentiment. President Trump saying China is, quote, not easy as talks are set to resume today. Would a rift in the fragile U.S.-China relationship derail the rally? Joining me now, we've got Jay Hatfield, Infrastructure Capital Advisor, CEO, and Chief Investment Officer. Jay, it's always great to speak with you. Talk to me about how you are viewing or potentially pricing a risk of these trade talks getting derailed.
Thanks, Maddie. It's great to be on. Well, we have a completely non-consensus call that all the trade talks, obviously China is the most important, but as a whole are not that critical to the U.S. economy. It's about 10% of the U.S. economy. The effective rate's going to be somewhere probably between 10 and 15. That's less than 0.5% of GDP. And meanwhile, energy prices, they were down 20, they're down about 15. That's a much more important driver of inflation. So we're bullish that inflation is going to come down. Even tomorrow, we're forecasting below consensus. And so we think that although it's been the key driver this quarter, earnings are going to be more important next quarter. So we're projecting a summer power rally.
So talk to me about the biggest risk to your outlook then. Is it that tariffs have a bigger impact than anticipated? Is it corporations holding off on hiring, CapEx, and that leading to a slowdown? Like, where would you see the risk to that outlook?
Well, everybody's focused on tariffs and how that's slowing the economy, but nobody's focused on the fact that the Fed has ultra tight monetary policy. They're actually shrinking the money supply, which is very dangerous. They did that before the great financial crisis. Normally it grows at 5, it's shrinking at 1. So the real issue, so I agree with the president, which I don't always agree with him, but the real issue is the Fed, they're slowing the housing market. It hasn't crashed because there's a shortage of housing. So I'd see the key risk is the Fed remains on hold because they're incapable of forecasting inflation, focus way too much on the expectations theory of inflation, which has been discredited, and failed to realize that tariffs even are a one-time cost, should be analyzed as sales tax and ignored for inflation purposes. So the three top risks to the market are the Fed, and the Fed.
Mm-hmm. So it's a great overview, Jay, because you see the power rally coming, but the Fed could potentially derail it in your view. How should investors be positioned then to benefit from that while also staying diversified to prevent against any potential downside risk?
Well, our scenario, so we're bullish on both bonds and stocks. Our scenario assumes that the labor market continues to slow. And even though this Fed has zero ability to forecast inflation, they are obsessed with the labor market. They're almost all Keynesians, so they're all believe the labor market drives everything. We strongly disagree with that, but that's what they believe. So we think this deceleration will continue. Inflation will continue to be really low if you correct for shelter, and that they will cut. So we don't give like probabilities of this and that and probability that an asteroid will destroy South America. We have a base case. We're going to stick to the base case. So we think that the number of cuts will be 2 to 3. Rates will come down, and we will get to the 6,600, which is 22 times next year's earnings.
So what's the best way to benefit from that then, Jay?
Well, we are recommending stocks that tend to be higher on the risk spectrum. So financials, so like Goldman Sachs, Morgan Stanley. We think the private equity firms like KKR are a great way to play it. REITs, and industrial. So be on the risk side. Don't be in McDonald's and Philip Morris and Coke because you're worried about a recession. We don't think there's going to be a recession. Think rates are coming down. So we'd be aggressive on the picks and go into companies that benefit from a booming stock market, or at least a increase in stock market, like the investment banks.
Jay, always great to get your thoughts. Thanks so much.
Thanks, Maddie.
Let's move to Washington. Senate Republicans are expected to propose revisions to key tax and healthcare policies in the President Trump-backed budget bill this week as lawmakers rush to get the bill done by July 4th. Congress members and key White House officials are expected to meet as early as Thursday. Joining us now on this, we've got Kevin Brady. He is former chair of the House Ways and Means Committee and architect of President Trump's original tax cuts. It's great to have you on this morning, Congressman. Thank you so much for taking the time. Talk to me about what you are hearing about what any revisions to Trump's tax bill coming from Republican leaders could look like.
Yeah, so first, I think my sense is the Senate is moving very swiftly toward that to July 4th deadline. It's more cumbersome in the Senate just because they take provisions and have to run them through the parliamentarian. It takes some time, but clearly from policy standpoint, they are accelerating their work, and I think trying to make these improvements in a way that it is acceptable to the House as well. No one wants to see this bill bounce back or go to a conference committee if it doesn't need to. So you're having these conversations going on. So I think the three big areas obviously is the savings areas. So issues like Medicaid savings, which is really just slowing growth. These aren't cuts to the program. It will grow by over $1 trillion. Certainly discussions about SALT and the Inflation Reduction Act. Senators are weighing on that, but they're also looking at how they can make improvements that, again, reflect their policy desires, but do it in a way that is manageable and acceptable in the House.
What do you think needs to be taken out?
Well, so I'm not there anymore, and I had a chance to shape all that in 2017. So I think
I'm sure they'll call you for insights.
It's they've got great leaders here on tax that I'm excited about. So I think growth here really matters. I think locking in these lower tax rates permanently, including keeping the corporate rate low, really important for jobs and innovation here in the U.S. I think fully restoring those three key business provisions that have been sort of weakening over the last few years on expensing research and development, interest deductibility, making that permanent, maybe one of the most pro-growth things in this whole bill. And then, of course, the making the small business Main Street tax deduction of 20% permanent and increasing it some. I think that's pro-growth as well, and will be reflected, I think, in higher revenues for the government in the future.
Well, let's talk about exactly that, because I've gotten to speak with you previously about the risks to the deficit. And as you know, some estimates indicate that this bill could result in up to $4 trillion additional dollars added to the U.S. deficit here. How much debt is too much in your view?
Yes, so deficits do matter, and I think there are various estimates. You're exactly right. I know the Congressional Budget Office is around $2.5 trillion over a decade. Clearly, this matters to Republicans. They're spending a lot of time trying to get the savings right and the policy right, and trying to increase that where they can, where it makes sense. So deficits matter. Growth can make a big impact. We saw record levels of growth of revenue above projections. In 2017, a great example, corporate tax rate we lowered from 35 to 21. There was a small dip, and then we ended up collecting far more at a lower tax rate than we were projected under the higher tax rate. So we know you've got both savings, really crucial to this. Then you've got the new revenue from growth that matters as well. So I think Republicans are taking that holistic approach. Let's do both to try to keep these numbers down as much as we can. I will tell you, Madison, I appreciate deficits come up when we're talking about taxes. It seems to be about the only time. If you average $2 trillion a year in new deficits, and no one seems to say anything. But when you're talking about giving people back a little more of what they earned, whether you're a local business or a local family, this becomes an issue. I'm really pleased the Republicans are taking that seriously as well, and you can see it in the product.
Well, another policy we're hearing about from the Trump administration that's aimed at increasing revenue is, of course, tariff policy. And I'm interested in your thoughts on this. The World Bank coming out with a forecast underscoring the costs of the trade war, projecting the global economy to slow significantly this year due to those tariffs. How are you thinking about tariff policy as either something that could boost revenue or could slow the global economy?
Yeah, so I think, I'm not a big fan of tariffs except in very specific instances as a remedy for bad action by our foreign competitors. My belief is it does drive up of costs in prices. It does slow the economy, and it invites retaliation. And so not a fan of that as a policy tool necessarily. But I think everyone agrees with China and other bad actors, those unfair trade practices need to be confronted, no doubt. Secondly, where it makes sense, we ought to be, especially on crucial security, critical supply lines, we ought to be anchoring these in the U.S. and having them run through our reliable trading partners. I think we're all hopeful that in these negotiations that the Secretary Bessent and Secretary Lutnick and our U.S. Ambassador on trade are having will result in lower tariffs overall, in fair trade practices, and the ability for the U.S. to invest and manufacture critical supply chains here in the U.S. I think, that's a tall order. There are a lot of countries here. I think the key is to do this in a way that actually builds on our current trading relationships rather than creates vulnerabilities. I look at Canada and Mexico, our two largest trading partners. Mm-hmm. They buy 5 times more of made in America products than the next country, which is China. It's really crucial in these discussions that we end up with a positive, reliable, pro-growth trade policy at the end of the day.
And one of the tariff-specific actions that's included in the One Big Beautiful Bill is Section 899, which would tax foreign investors from countries that this administration believes have unfair trading practices when they are invested in the United States. And what I've heard, especially from my fixed income sources, is that only adds fuel to a fire that's already started where foreign investors are pulling out of the United States amid the trade war. Can you talk to me about the degree to which you think members of Congress are monitoring foreign investment in the United States as part of their thinking in this tax bill?
So I really believe lawmakers, especially Republicans, believe in the growth and the importance of foreign direct investment. It's a sixth of our entire economy, creates jobs, innovation, allows us to compete. Much of what we are invested in is U.S. manufacturing. They go out and sell made in America around the world. So there is no question. There is no question. Foreign investment is an incentive that Republican lawmakers believe in. The problem here is the OECD, and under the Biden administration, what was negotiated in this global minimum tax, Pillar 2, as they call it, basically would take a bite out of the U.S. tax base, would weaken our growth incentives in the tax code, and basically usurp America's sovereignty to write tax law in American interest. And so this provision was added really as a deterrence to OECD countries, to basically insisting, work with Americans to get this right. And I think the U.S. Treasury is very fair on this global tax debate right now in a good way. And so work with America to address their concerns, and you won't see these provisions take effect. I think that's the goal of the legislation. I don't think anyone wants to see any lessening of incentives for foreign investment. I think there could be some changes in the Senate that tweak this in a way that gives Treasury some flexibility. If countries are coming the right direction, working with us and all, because I don't think anyone wants to see that provision actually take place. But certainly a strong signal is being sent to our global competitors. This is not how you negotiate global tax treaties that are so damaging to the U.S.
Former Congressman, so appreciate your time this morning. Thank you so much.
Good to see you, Madison.
We're going to have all your markets action ahead, so stick around for more.
The itinerary for global markets this year has been busy, but the S&P 500 has barely left the gate, up a modest 2%. Meanwhile, several single stock ETFs have already gone long whole, chalking up 30 and even 40+% gains. And today, we're going to see who's been filling up their passports with the juiciest returns. I'm Jared Blickery, host of Stocks in Translation. So let's take a look at the country leaderboard. Greece and Poland are at the top of our list. Each of these European countries are clocking in returns in the mid-40s. Austria and Spain are right behind at 40% each, with Italy in the mid-30s. Continuing down the list, Germany is right behind Italy with a 33% surge. Meanwhile, the UAE, Israel, and Japan are each posting respectable low double-digit gains this year. And in case you're wondering, these ETFs are all priced in US dollars, so these gains are also benefiting from the broad-based weakness in the US dollar this year. Another note, this list is not meant to be exhaustive. Now, let's flip through some of the charts here. First, the record relay, as I'm calling it. Germany tagged a fresh record high last Thursday, followed Friday by Israel. And that's after Japan notched its own record earlier in the week. It's almost like global momentum is passing the baton. Now for the Mediterranean makeover. Check out Greece. Like a phoenix rising from the global financial crisis ashes, Athens is back on investors' radar, flaunting the highest price in nearly a decade, though still down 25% from its 2014 high. And say hello to the periphery. Club Med is back, with Spain and Italy joining the Greek resurgence. All three of these indices are up 50% over the last 2 years. Shifting north, Poland and Austria are leading a Central European surge, with Poland up over 50% in the last 2 years and Austria just short of that. And don't forget about the United Arab Emirates to the east, just a hair from a fresh decade-long high as it's returning 25% plus over 2 years. Finally, let's take a look and zoom in on Austria's long-awaited breakout, nearly 2 decades in the making. After the roller coaster ride along the global financial crisis, the country traded sideways for 17 years, finally breaking out of a trading range only a month ago. Bottom line for investors, yes, these returns are impressive, but is U.S. exceptionalism really a thing of the past? Have the volatile tariff experiments, have those up the uncertainty vibe too high? Or did the post-Liberation Day market plunge clear the deck for the next U.S.-led surge? If so, the last month of consolidation near record highs in the S&P, that might just look like a layover by year-end. And if not, we could just see some more sideways action that frustrates both the bulls and the bears. Only time is going to tell, but you cannot deny the bullish price action breaking out around the world this year. And tune in to Stocks in Translation for more market decoding deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Thanks, Jared. It's now time for some of today's trending tickers. We are watching IBM, Meta, and McDonald's. First up, IBM says it's building the world's first large-scale fault-tolerant quantum computer. It'll be housed in the company's New York data center and have 20,000 times the computational power of today's quantum computers. The computer, which is called Starling, is set to launch by 2029. Next up here, Meta, creating a new AI team. According to reports from Bloomberg, CEO Mark Zuckerberg is assembling a team of experts to achieve artificial general intelligence that's referred to internally as a superintelligence group. Zuckerberg reportedly aims to hire around 50 people for the new team, including a new head of AI research, almost all of whom he is recruiting personally. And finally, McDonald's getting a double downgrade at Redburn Atlantic, cut to sell from buy. Analysts also lowering the price target to $260 from $319, citing the threat from weight loss drugs. This was the third downgrade for McDonald's in the past several days, following cuts from Loop Capital and Morgan Stanley as well. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're going to have more markets action for you ahead when we come back. Stay tuned. JM Smucker sinking after issuing disappointing guidance for fiscal year 2026. The maker of Folgers coffee and Jif peanut butter reporting mixed results for the fourth quarter, with net sales declining 3% from a year earlier. Joining me now, Robert Moskow. He is TD Cowen's managing director. Moskow, sorry about that. Thank you so much for joining us. Talk to me about how you are viewing these results. The stock right now having its biggest drop since 2006. Why is there such a negative reaction?
Well, the big negative news here was coffee. We and I think the street expected the company to guide coffee to flat profits for fiscal 26. They have to raise prices a lot to offset higher input green coffee costs and even some tariffs. But in the past, they've done a very good job of keeping profits somewhat stable as they raise price and managing elasticity. But this guidance is for over $100 million of a profit gap on coffee, so down substantially in fiscal 26. And that's tough for investors to swallow.
It certainly is, but it's also tough for them to swallow the price increases that we've seen with regards to coffee, especially given that we haven't even fully seen the impact of tariff policy yet. I'm curious if you can talk a little bit about what Smuckers could have done, if anything, to prevent some profit squeezes off the back of that.
Well, the coffee input costs are out of their control, but what they're going to do is raise prices in May, and then they're going to raise prices again in August, and the cumulative impact is going to be about 20% to the consumer. They're expecting a 10% volume decline from these actions. That's a historical relationship for elasticity. My question on the call was, why so glum? 1 month into the fiscal year, volume's actually up in our retail tracking data, and there must be something that they see coming through in the next several months that will hurt that data, and they must see something that there's a mismatch that we can't tell in our data.
Did you get a sense of what that is?
Some of it's timing. The costs come in first, and then the pricing comes in after. They say by the end of the year, that their pricing actions will offset the cost. So maybe that sets up for a fiscal 27, which they say will return to normal for them in terms of their growth algorithm.
It makes me wonder, too, one of the notes I saw from analysts this morning indicated that they have a history, this company, of being a little too cautious when it comes to guidance. And you also said the same. Why so glum? Do you think there's any chance that this is just sort of their approach to moments of volatility, to be more cautious in their signaling to Wall Street and then later surprise to the upside? Or do you think it's something more sinister this time?
Yeah, I think it's possible. I wrote it in my report that or my first impressions that they do have a tendency to be very conservative in their guidance. And in fact, if you look at fiscal 25, the year they just finished, a lot of companies missed numbers. They did not miss numbers. But I think the stock's going to be in the penalty box for a while here until there's more proof that this price cost relationship at coffee is working to their advantage, or at least not as bad as it looks. And then they also have to get past the lingering overhang on the stock from the Hostess acquisition. Their capital allocation history has been very spotty. They overpaid for Hostess. They just took about $1 billion of a charge on that, and they guided Hostess even lower than what they thought the business would do just a few months ago.
And I wonder if we can broaden out a little bit to other CPG names, because so much of what we're talking about could impact peers in the space. I know that you see a back half recovery for a lot of those names. Talk to me about what's driving that view.
Well, what I wrote in my research was that a lot of companies are expecting a back half recovery, and over half of them I think are overly optimistic. And now after looking at these numbers, I think maybe it's even more. I think that this is the pattern for CPG. They think that the first half is will be tough, but we will sequentially improve during the course of the year as the consumer gets used to higher prices, or as they get used to the shock of concerns about tariffs and other geopolitical instability. I am very cautious on CPG for this year. There's a few stocks that I like, including Coke, McCormick, and Unilever, but that's out of 36 names.
Right, and I also taking a look at some of the other names that you just identified as low risk. You have the likes of Colgate-Palmolive, Monster, Mondelez, as you said, and Unilever as well. Is there any theme to you of the stocks that will be survivors of the CPG basket in this view that kind of ties them all together?
International exposure. What most of those have in common is more of their sales are in higher growth emerging markets. Even Europe, the consumer has been more resilient than in the U.S. So this is a time when international exposure is a real positive, and Mondelez and Coke, over 60% of their sales are overseas.
And to what degree do you consider declines in the dollar when you're thinking about those with international exposure being beneficiaries of any optimism to come in the second half of this year?
Yeah, it's obvious. It's a positive from an earnings translation perspective. It's not the primary element of our thesis, but it does give them a little bit more fuel for reinvestment back into marketing, or at least to protect any downside from unexpected circumstances.
Right, a potential cushion in a time where it might be needed for some of these folks, as you mentioned, Robert. Right. Thank you so much for joining us. Really appreciate it.
You're welcome. Thank you.
We're going to have all your markets action ahead. Stick around. You're watching Catalysts. Professional services firm Aon, which helps clients manage risk across commercial, reinsurance, health, and wealth issues, held its first investor day in nearly 20 years on Monday. During the event, the company outlining its plans for growth and discussing mega trends most impacting clients across trade, tech, weather, and the evolving workforce. Joining me now to discuss those and more, Gregory Case. He's the CEO of Aon. Thank you so much for joining us in studio.
Madison, absolutely a pleasure to be here today, and really look forward to the conversation.
Yeah, I appreciate it, Greg. So let's start with those trends that are impacting clients. Obviously, you manage risk. That's a key part of your role, of course, for the company. What is the risk that folks are most worried about that you're hearing from?
Well, I have to say, Madison, and you mentioned our investor day. This is what we talked about yesterday quite a bit. Investors were very excited to sort of understand risk in a comprehensive way. We talked about 4 mega trends, really around trade, technology, weather, and workforce. And all these trends, turns out they're everywhere globally at all sizes of companies, large, medium, and small. So there wasn't any single one that came out. The central theme was around the connectivity of these risks and how powerful it is to sort of see them come together. So if you think about sort of the implications of weather on workforce, massively important, not just in concept anymore, but if you're thinking about how you put workers on the field in heat environments above 120 degrees, but you can't do that, how do you react to that? How do you think about it? So it was really around helping our investors and our shareholders understand how we approach the world as we support our clients in the context of these mega trends that impact what they do every day.
And I'd love to hear more about how you're advising folks to approach trade challenges, as we obviously have the US and China in talks today regarding trade. It continues to be a developing policy measure. What are you hearing from folks about their worries, and what are they doing to address?
Wow, I will tell you, the Megatrends report came out in May of 24. So that's before the election and before April 2nd. And we talked about trade at that point in terms of global supply chain, the volatility in global supply chain, how you think about current and how you might shape it over time. All these things sort of were front and center as a mega trend before tariffs.
Right. Well, it was post-COVID too. I mean, supply chain managers.
Exactly right.
We've had empathy for them for years now.
Right. And even more so in Madison, it was acute before April 2nd. Then you add on top of that additional potential volatility with tariff. And so, we have a number of things we do to help clients understand risk in detail. By the way, understanding in a way in which you can do something about it. So, we have a supply chain diagnostic that will actually value sort of impact of things like tariffs. I will tell you, April 2nd, the announcement happens. April the 11th, we do a webinar. I'm wondering, who's showing up for the webinar? 6,000 clients and participants show up for the webinar on literally help us understand what this might mean for volatility in our supply chain. Does the current one get better or worse? Do we have to shift supply chain overall? How does one think about that? What's the timing of that? So all these sort of questions are embedded in how do we take action in a world that actually was volatile before, but might have new sources of volatility. This certainly was one of them. So that's the nature of the conversation we're having, to get the very explicit moves that clients can think about making.
And that's really helpful in terms of understanding sentiment amongst your clients. We had a source on the show yesterday from Citizens who said that he suddenly heard from his private banking clients that they think we're in a normal now and the market is acting like trade policy is normal. Have you heard less concerns from folks since April 2nd than you did initially? Or what has that sentiment change looked like, if anything?
I will tell you, we live in the world of clients. This is what we do every day. We're talking to literally, and we're in 120 countries around the world. We're talking to all clients, large, medium, and small. So we really do get a window in the raw feed at the front line. And in that regard, there's been no back off. Trade was a mega trend before, more volatility. We're helping clients today think about what courses to take. I would say one underlying theme, though, that might be interesting to your listeners is this is about taking action. You learn from COVID that inaction is not a good action, and hope is not a strategy. You've got to understand volatility in a way in which you can do something about it. And in the course of trade, same with technology, weather, and workforce, it requires real specific understanding so that you can walk down the hall to your colleagues in the C-suite and say, here's what we're doing about what we understand the situation to be, and you actually have a plan and action. That actually is not backed off in the least.
So what is the right action item? We've heard from some companies in their earnings reports to diversify to as many countries as possible so that they have that really diverse supply chain. What is the recommendation?
So there is no recommendation. There is what's specific to a client strategy, what's important to them, what they're trying to accomplish. In some cases, it may be diversify. In some cases, it may be double down, depending on where they are and what they're doing. And you're always measuring that against a deep understanding of volatility. This is the other piece we talked about in our Investor Day, which is we've got a tour de force effort and a set of analytics, all with embedded AI in the middle of it, that is really around understanding volatility. And understanding global supply chain in the context of tariffs is a massive undertaking. And it's got to be addressed so you can take action.
Well, let's talk about AI. What are you hearing in terms of any movement towards labor replacement with the use of AI going forward?
Well, I'll touch on the trend and then I'll touch on Aon. The mega trend is really, if you think about the mega trend of technology with workforce, consider that literally 40% of the roles as they exist today, 40% have got to be retooled in the next 5 years. This is like an astounding number in terms of coming back to where we are. From our standpoint, listen, we've been doing this, involved in AI, generative AI, for quite some time. Our view is we are the only bet in our industry on embedded AI at scale, the only bet. And the reason is two. One is high fidelity data. Without incredibly high fidelity data on a global scale, this is the engine that really drives the insight that comes out of AI and what we're doing analytically. And then the second is how we're structured. We describe it as a connected, united firm. We're 60,000 colleagues at 120 countries, but we call it Aon United. It really means that we've got to be talking to each other. It's got to be able to be scalable. And for us, we've got 15,000 colleagues working in a group called Aon Business Services, which is really the engine that sort of drives this, the embedded AI. They then get scaled to 60,000 as we deliver for clients. So for us, we've been taking this seriously for a long, long time, and we are coming up with a set of analyzers and insights. So we've got a supply chain diagnostic. We've got analyzers in all core aspects of our business that we take to clients to give them insight they wouldn't have otherwise had to make decisions that are better and faster than they would have otherwise done. So for us, we're all in on this one.
So to what degree do you see clients taking that information and replacing workers with AI?
Well, it is both. It is action, and there is opportunity for replacement in many respects. In some respects, there's also opportunity for amplification. Amplification, literally, the group you've got, how they can be better. And opportunities you bring people in that you're just not adding, but you're also making them better as you do that. So it is really a combination. There is no one size fits all. The focal point is around subtraction. But for us, we look at it as defend the house and build the house. How do you actually defend and understand the volatility so you can actually take action to prevent it? But also, how do you think about growth and how you drive growth in a way that fuels your business in a productive way? Not just with efficiency, but really a better answer on the field for your clients so that you can actually grow. Both pieces.
Greg, really appreciate your time this morning. Thank you so much for coming in.
Great pleasure, Madison. Thanks so much.
Coming up, what the GOP tax bill means for municipal bond investors. We'll get you that conversation next. JP Morgan raised its forecast for municipal bond sales to $460 billion this year, the majority of which it expects to remain tax-free. As the GOP tax bill continues to work its way through the Senate, what could the incoming shifts to the U.S. tax code mean for muni investors? I want to bring in Sylvia, Goldman Sachs Asset Management co-head of Municipal Fixed Income. Sylvia, great to have you in studio. Thank you so much.
Thanks for having me.
So it seems like the potential worst-case scenario has been taken off the table in terms of the tax bill's implications for munis. Talk to me about that.
Yep, I mean, to start the year, we definitely had a lot of headline around the muni market. I feel like we get that from time to time with the change in administration. And maybe this time we really thought there was going to be a chance that the tax exemption would be disrupted, nevertheless, potentially removed. So it's been great to finally feel some sense of relief come back to the market, believing that that's off the table. I don't think that means that munis are safe. I think that there will be, just tangential implications with respect to maybe endowment taxes, maybe certain sectors of the market still on the table if the administration is looking for dollars. But the tax exemption in totality as it stands and what we all look for when we're investing in the municipal market seems to be okay for now.
Yeah, and you mentioned that's a removal of a big headwind, but there are also still other potential policy risks on the table for munis. Why is now the right moment for investors to be looking into municipal bonds?
Yeah, and it's nice to actually feel that it's a great time to invest in municipal bonds.
Yeah.
We have a few really nice, tailwinds here, and I think the yield environment, first and foremost, for a really long time, we were in a period where investors weren't really excited about where actual yields were. Why invest? Why not just sit in cash? So to see yields and be in an environment where we're actually seeing nominal yields north of 100 basis points higher than they've been over the last 10 years on average across the curve is pretty exciting. Like, there is meaningful income behind that. And then I would say from a valuation perspective, when you compare it to treasuries, which is a natural for most muni investors, the valuations are saying that the muni market is attractive, like lean in, dip your toe in. And then if we look from a credit profile, which is a real strength that we have in the muni market, credit fundamentals remain strong. And I think that's a really important message. So you have three major boxes ticked, and it's almost like, what else are we waiting for? The time is right.
And since you mentioned it, I am curious about any sort of competition that might occur with U.S. Treasuries. We have some folks who come on and say they still see the 10-year hitting above a 5% yield this year. Yeah. Does that present a headwind to muni bonds in any way? Talk to me about that.
Sure. So I think we're always looking at munis fair value versus treasuries. I think we are looking at taxable muni versus treasuries. I think that there is a preference or a belief that treasuries offer more liquidity versus munis. I think that the current market landscape is actually encouraging us to look beyond traditional fixed income in munis and treasuries and look at corporates, investment grade corporates, right? Yeah. And looking at that pack of four, almost as close as, I guess, a credit profile as you can expect, and looking as to where the value and where the opportunity is across all four of them. Sure. So using Treasury as the base point, even though it's no longer AAA, but using that as our baseline where we want to get started and what we think the value is, excuse me, and what the actual portfolio composition would look like. I think there's going to be opportunity across the board and across those four sectors, just given the uncertainty and the volatility that's going to stay with us through the end of the year.
I was just going to ask you, since you bring it up, the Moody's downgrade, and to what degree that impacts your space, if at all.
Yeah, it's something that we definitely have to pay attention to. It was the last of the rating agencies. I think that, most asset managers have taken that into consideration over the years with the other downgrades that we have seen. It's still the United States of America, so I think we need to take that into consideration. But munis largely are rated AA, AA minus, right, in totality, and we still have about a dozen municipalities that are actually rated AAA. Yeah. So not discounting the United States, still strong credit quality. Again, headline noise for some clients who might not be in the weeds and as sophisticated, but not something that I think we're worried about longer term.
And I think one of the other things that I've heard a lot about from some of the folks that I've spoken with has been this concern about state and local government spending, not just, kind of the federal budget, but that state and local government budget. To what degree does that impact how investors should be looking into opportunities within munis?
Yeah, really, really good point. Munis have been in the market for about 26 years now, and we have come a very long way. Do-it-yourself market, too, we should not be doing it ourselves anymore. And largely, the biggest reason for that is going to be the credit quality and the credit profile of all of these munis. Post-financial crisis, when the monolines lost their AAA, it is so important that we're looking under the hood on every single name that we have, and they're not all created equal. what we also need to keep in mind is post-COVID, a lot of these municipalities received a tremendous amount of cash that they've responsibly managed X amount of years later. They're still at high percentages. They're being used, but they're being used sparsely. That, with the revenue streams that they're getting and the diversification of those revenue streams more broadly, they're pretty resilient.
Well, it's interesting. It makes me think, too, about, for our audience listening who is excited by the resilience that you're talking about, what are those best opportunities where they could potentially get some great returns?
Yeah, there are so many. I mean, there's so many, going back to not doing it yourself, and this is where we get excited because there's so many different ways that you can access the muni market. The same way no two munis are the same, no two clients and their needs and wants are the same either. I think there are traditional mutual funds, which will always have a place, especially if you're looking to access parts of the marketplace that you can't kind of do on your own. There, I think about municipal high yield. GHYIX, our municipal bond fund, is doing tremendously well, and really that individual bond selection and sector focus has really allowed that fund to do and provide for clients what it's supposed to do. And then I think I look at separately managed accounts, which have grown tremendously since the financial crisis because of the transparency and the customization and the personalization that it offers, allowing clients to have their influence in their investments have really, really grown. So for clients who want that customizations, that's a really great place to be. And then ETFs are the new trend, so you can't not talk about ETFs. And we just launched our suite of muni ETFs at the end of July last year, and we have a really short duration, ultra short duration product, Gummy, which allows us to take advantage of the front end of the curve and help those clients step out of cash and into the market. And then we have our traditional intermediate, GMUB, which allows us to really have beta access to the marketplace. And then piggybacking off of what we do super well, our opportunistic municipal bond fund allows us to really look for those best ideas in mutual fund format. We're bringing that in ETFs with a concentration and focus on two high tax states, California and New York. So we're trying to allow our platform to really evolve to meet the needs and wants of our clients. So it's an exciting time.
Exciting time. Thank you so much for joining us.
Thanks for having me. I appreciate it.
Coming up, we've got Wealth dedicated to all your personal finance needs. Stick around.